Hi, I'm James Dunn. Welcome to the Inside Network. Welcome to INDepth, where I'm speaking with Joel Fleming, Portfolio Manager of the UBS Micro Cap Fund, which is managed by Yarra Capital. Joel, welcome. Great to have you here.
Thank you very much.
Joel, I'd like to start by congratulating you on the fund's long-term performance. It's been pretty impressive. Generally speaking, why should investors have an exposure to microcaps in their investment toolkit?
It's all about long-term capital growth, James. That's what we're doing in microcaps. It's not about income, it's about small companies today that become much larger in time. So really about driving that longer term capital growth. The world's dynamic, this is a very inefficient part of the market, and that opportunity to take these small developing companies as the world continues to evolve and change and the drivers of economies and things change, we believe there's just a real opportunity here to find small today, much bigger in the future, and for that to help drive your long-term wealth.
What are the capitalisation borders around your strategy? I suppose a way of asking that differently is, what exactly is a microcap to you?
Great question, and lots of people define it differently. So for us, we want to sit next to our fantastic small cap capability and offer our clients something different, but with the same underlying investment process. So $250 million market cap is at our top end. So when the stock goes in, has to be below $250 million. And because we're aware that this is capacity constrained, we can look at businesses as far down the spectrum as about $30 million. Now at that end, they're obviously less liquid, they're smaller position size, you're going to own a lot more of the stock, but we can genuinely have a look at a $30 million company, and if it's got all those attributes, we can make a start for the portfolio.
With these capitalisation-based strategies, it's always interesting, what do you do when something goes well and pushes through the upper boundary? Do you keep it or do you hand it over to the small cap team and so that the firm still owns it?
Yeah, so for me, I've got a lot of money invested in this product. I don't invest on the ASX outside of this. And if we've done the work early, we've identified the company, we've built a relationship with management, we've got a really good understanding, and we think we know something that the rest of the market still is not aware of, we want to keep it because that's where our gains have made. It's not about a stock doubling here, tripling. The really good ones can give you returns of 10, 20, 50, 100 times your money. So for us, it's all about asking the question, what's our edge? What do we know, or what's our understanding that the market doesn't know, that means this stock can continue to drive higher? Because the best examples of success in this fund are those great compounding stocks. And the bigger they get, means more people can look at them. Their investable universe for other investors, this starts to fit into it, and that in itself can be a really important driver of returns as going into indexes and things can. So long answer, but I think the real key is we don't want to look like a small cap fund, but if we're done the work, found something, and we believe it can continue to go on to great things, that we're going to try and capture as much value there as we possibly can.
It's really interesting when you look at your fund. You often hear people talk about this, that there's two share markets in Australia. There's the ASX 200 and then there's another 2,000 stocks outside that. Or say the 300 and there's another 1,900 stocks outside that. And often, Joel, they're in that bind where they're small because they don't get attention, and because they don't get attention, they never grow. How do you navigate that kind of tyranny of size and really back yourself to pick ones that will grow?
It's a really, really good question, and it's probably, at the moment as about stark as you can get. So as interest rates went up, we saw a lot of liquidity flow out. There's been not a lot of IPOs, there's been not a lot of capital raising activity and things, and we've seen that big part of the market outperform. I go back to basic economics. If you're a company and you're growing and you're profitable and you're generating cash flows, that's tangible value. And we're looking for companies that are involved in things that going forward are going to be more important. So they're growing their market share, that's sustainable growth. They're having stronger foundations in terms of the company's, underlying fundamentals. Whether it be via M&A, whether it be investors starting to notice, patience is a virtue, but that's something that can be well rewarded. So, you're not buying conceptual stocks and themes, defence is hot, biotech's hot. It's about those underlying fundamentals and those things that can be truly valued. Cash flows, profitability, position in market, all of those good things. With patience, that will be rewarded. And as the companies get bigger, you start to have more people looking at it. They go into indexes and then you start that positive cycle. But there is that little period. And for us, that's part of the advantage. That's where not everyone's looking, that inefficiency.
Yes.
And we're at an inflection point where as those things start to come into the fore, markets start to reward it. So I actually look at it as a positive. It's probably more inefficient than it's ever been, but with interest rates going down, I think that money starts to cascade back down into our part of the market. See some M&A, again, it can completely change the narrative very, very quickly.
A lot of herd mentality in investing as a professional investor in stocks, particularly in Australia, particularly in small caps, but I imagine it wouldn't be there for you, and you would have to be comfortable in quite a few cases with being probably the only institution on the share register.
Absolutely, the path less travelled, and where we get our gains is by going out to people's businesses, right, and sitting down with them and trying to build an understanding of the market's very focused on what's going to happen in the next 5 minutes and whether that's good or bad.
Yep.
My experience has been that to build a business takes time, and we want to understand, what are you doing today? What investments are you making? How are you positioning your business so that in 3 years' time, the market might think you're making 2 cents a share, but you're actually making 10 cents a share, and that 10 cents is going to double after that. And it's trying to identify those opportunities, those big, structural themes happening out in market, how the company's positioned, why we think that they've got a better chance than anyone else of being successful. That's where we operate. And that's actually a good thing, because it means you rely a lot on your own work, and to an extent you're protected from that herd mentality where everyone's focused in on a very, very small number of stocks, where our job is to identify in 18 months, in 2 years, the stocks that everyone's going to be clambering over, and seeing that benefit from being early in that investment.
Most people, Joel, would look at your universe and probably assume that it was going to be, there's a lot of mineral explorers, there's a lot of moonshot biotech situations, but do you think a lot of people would be surprised at exactly how many profitable industrials that are paying a dividend are actually in your world?
Absolutely. And again, there's still an education piece that has to happen with microcaps. So, I think a lot of people, a lot of investors like having a punt on things that they consider to be a bit risky and things like that. We bring a disciplined, professional approach. We build a portfolio. We think about risk. If something goes wrong, it's not terminal. There's the way that we structure things. It's really, really important. But in terms of education, 20 years ago, small caps were an emerging theme. People were starting to put those into portfolios. I see microcaps as the next iteration of that, where it's about the inefficiency, it's about not everyone can do it, there's capacity constraints and all of those kind of things. And yes, there are a lot of promoters, there are a lot of stories that will never go on to amount to anything, but there's a huge number of really good companies exposed to really positive themes, providing niche exposure to things that you can't get in other parts of the market. So as things evolve, it starts down here. The CBA doesn't come up with the next generation of the great theme in financial services. It tends to happen lower down. And so for us, most of the portfolio is profitable, growing, a lot of it pays dividends. That's the bulk of what we do. And I think you are right, people are surprised. And the valuations tend to be a lot lower too. So side by side, you look at a company and you say, same industry, faster growing, taking share, trading at a discount to someone else, that's got to be pretty compelling, I think.
Joel, you spent your career in emerging companies, microcaps, small caps. What have you got against large cap companies?
I think it's just the opportunity and the interest. So I remember I was running a small cap portfolio And I started to, look at companies like Dulux and Super Cheap Auto, and I'd noticed there's not 3 brokers anymore, there's 12.
Yeah.
And everything is managed within a very small tolerance of information, and people are crawling all over these companies. They're constantly in the press and things like that. As an investor, inefficiency is your friend, because if I turn up at a business and I'm signing into the visitor book and there hasn't been an institution through ever or years ago, surely that's advantageous that you're spending that time. So large caps, big part of the market. There's always money to be made, but for me, the ability to do your own work, be curious, actually spend time building relationships and understanding what they do and how they fit in, and being able to test that, validate that, talk to the customers, talk to the competition, and really get to the bottom of whether A, this is a good idea, whether this is the team to take it forward, whether the capital structure is right to give them that opportunity. I mean, that's just an awesome thing to be able to do. And we get plenty wrong, but when you get them right, it's very, very satisfying.
Generally speaking, Joel, what role does a micro-cap allocation play in a portfolio? And again, generally speaking, why should investors have an allocation to this area?
Yeah, so I think people look at microcaps in terms of those higher growth portfolios. So if you're looking to grow your wealth and looking to take on some extra risk, microcaps are a satellite strategy. They tend to be a small part of the portfolio, but they punch above their weight in terms of that return that they can generate. I guess the other thing is we try and manage risk so that we're not going to be in a situation where the return is significantly more negative than the market, or the volatility is significantly more volatile than the index, for instance. So that's important. And I also think that there's some correlation impacts as well, that the correlation between microcap stocks and other parts of the market can be different. And it's something, you're getting a portfolio that can't be replicated through an ETF or a passive fund. You're getting something that your small cap fund manager is not providing you. If you're aware of that capacity piece, and we can invest in small companies, not a lot of other people can. And so inefficiency, that correlation, that long-term capital growth potential. And for me, it's all about, the world's very dynamic. We're all getting older, things are changing. How our children look to consume is very different to what we did. Microcaps is where some of these emerging themes are going to play through. And so that opportunity for a small company today to become a leader in what they do, in maybe a field that wasn't even thought about a decade ago, to me, that's a pretty good base, particularly when it's so inefficient.
You are at the high return, high risk end of the market. So what's been an example of one of the best stocks you've ever bought for the portfolio in terms of performance?
Yep.
And what's one that maybe blew up?
Great questions. We'll start with the positive. The calling card, and I'm so thankful for having gone on the journey and seen what this business has done, but Pro Medicus. So first day of the fund, we bought that stock for 86 cents.
Goodness.
It was profitable, it was dividend paying, had cash in the bank. It's a really good business. Now they made an acquisition which completely changed the trajectory of the business, but lean cost base, really good quality management that were really good people that were willing to spend the time with you explaining a very complex area, and how that company has evolved in its valuation today, which unfortunately we don't own anymore.
I was going to say that's a 250 bagger if you still own it.
But we caught a lot of the journey, and for us that was such a calling card of, small companies on the ASX, based in Richmond, with a staff of sub 50 people, can become a market leader in a field where you are competing with some of the biggest companies in the world.
Global market leader.
That is an incredible, incredible journey. And so it was a privilege to be involved, and still to this day, you dream of seeing another one like that. So that's obviously been the standout, but we learn a lot of lessons from that. On the negative side, we've had a lot of things go wrong, of course. Probably one that stood out to me where should have acted a bit quicker was a business called NextEd. So it was about international students. And we had two bites at the cherry here. We were caught when COVID happened. We'd consider that more of a macro black swan style issue. We can be forgiven for that. But as the Labor government, things started to open up again. We're bringing a lot more students into the country, and we saw, because of our knowledge and understanding, we thought we could get back into that stock, and that should benefit from some of the changes happening in market. And I think an awareness about changes in government policy and things, we were caught on the hook a little bit, held on too long, and it was a pretty disappointing decline in share price before we got out. But the theory was right in terms of the things that were going to drive the business, and I guess we just weren't on top of some of the changes that were occurring beneath the surface, and it was disappointing when you go back into something and you have a second negative experience.
What's the biggest holding right now?
The biggest holding right now is Energy One. EOL, market cap's about $480 million. Really good, interesting business, because one of the big themes out here is, the grid and energy and all of these things that are happening. And they're as relevant here in Australia as they are in every country in the world. And these guys have got software that help companies operate within the grid. So if you build a solar farm, your ability to dispatch energy in and all of those kind of things. Really strong market share in Australia and a growing business in Europe. And these markets continue to deregulate and become more complex. So for us, it's a software business. It's got a really good model in terms of those software recurring sales. It's a company that's come out and said, we think we should be able to grow our top line at 15 to 20% per annum, and our costs should be growing at a lot less than that. So we've got some expanding margins. And I just see a market that's changing with a validated product in there with a lot of opportunity to grow and become a market leader. And what I particularly like about this story is there was a false start. They had a takeover bid that fell over, and they had to do a lot of inward thinking about how the business was structured. They've made those changes, and that's been a fantastic performer for us over the last particularly 12 months, but that's our biggest position currently.
Fascinating stuff, Joel Fleming from the UBS Microcap Fund, which is managed by Yarra Capital. I could talk about microcaps all day, but we don't have all day. Thank you so much, Joel, for appearing in depth.
My pleasure, James.